Hi, thank you for joining us today. We are going to talk about taxation on stock that is sold out of an employee stock purchase plan. So if that's not a question you're interested in, it's time for you to go get coffee. If it's one that applies to you, thanks for joining us. This is Dee Dee Jones with Innovative Financial, helping you understand your financial world and empowering you to make great financial decisions. So today we're talking about stock that's purchased in an employee stock purchase plan, ESPP. That's what I'm going to call it going forward so that I don't trip over my tongue. And it comes down to first question, have you sold stock out of that plan? And if the answer is no, guess what? It's coffee time for you. But if you want to know what will happen when you sell it, or if you've already sold it, follow along with me. First, we have to ask, it's going to be a whole series of questions, and we have several branches on this process today, so hang tight. First question is, did you hold the shares for more than 2 years after the option grant date, basically the start of the offering period, and for more than 1 year after the option exercise date, the end of the offering period? So as our first question, branching question is yes, no. If you were able to answer yes to both of these, it is a qualifying disposition, which is going to give you slightly more favorable tax treatment. Next question that's going to affect the taxation, was the bargain, the discount that your employer gave you, greater than your profit upon the sale of the shares? Here's a branch. If it was, you're going to pay ordinary income tax on the amount that the shares fair market value on the disposition date exceeds the amount you paid for the shares under the option. Okay, cool. If the bargain was less than your profit on the sale of the shares, you will pay ordinary income tax on the amount that the shares fair market value on the option grant date exceeds the option price. In either case, your cost basis in the shares will be adjusted to include the amount taxed as ordinary income. So you're going to get a bump up in basis, and you've gotten some benefits. And so while we're still talking about a qualifying disposition, did your disposition price exceed your cost basis? If it did, yes, the difference between your disposition price and your cost basis will receive long-term capital gain treatment. That's going to be a lesser tax amount than ordinary income. So that's an advantage. And if it doesn't, if your disposition price does not exceed your cost basis, then the difference between your purchase price and disposition price, they'll receive long-term capital loss treatment, which can be helpful depending on your tax situation. So those are the situations that apply to sales of stock that were held for more than 2 years after the option grant date and more than 1 year after the option exercise date. So what if you answer no to that question? Then what you have is a disqualifying disposition, and the rules change. I didn't warn you, but perhaps I should have. This is kind of complex. If you have a disqualifying disposition, you will pay ordinary income tax on the amount that the shares fair market value on the option exercise date exceeds the amount you paid for the shares under the option. Okay, ordinary income on that bargain component. Now, here's a little bit of a branch. Did you hold the shares for more than 1 year after the exercise date? If you did, the difference between your disposition price and your cost basis, they are going to receive long-term capital gain loss treatment. So gain or loss, you get that long-term treatment, which generally is advantageous. So that sort of splits out the bargain component of the employee stock bargain offer and how long you've owned it. However, if you haven't held the shares for 1 year, the difference between your disposition price and your cost basis, they will receive short-term capital gain or loss treatment, which is generally ordinary income tax rates. Here's the thing. If you've got the opportunity to buy stock in your company and you like your company and you feel confident in it, employee stock purchase plans are absolutely a fantastic way to invest, as long as you keep an eye toward diversification. But because you can get this great tax treatment on qualifying distributions, and you can get that long-term capital gains rate and the increase in basis on the stuff where you pay ordinary income tax. For folks I meet that have these as an option, I encourage them to consider it. It's a great opportunity. It's sort of another way to boost your compensation from your current employer. But as you can tell, it's a very, very complicated area. If you've got more questions around your employee stock purchase plan and how selling stock out of that might affect you, and perhaps you would like to walk through that again, please reach out to us. That's what we're here for. Dee Dee Jones with Innovative Financial, helping you make great financial decisions. Thank you and have a great day, guys.